Let's move on to the next section where I'll talk a little bit about option premiums and why they are priced a certain way. Welcome to the next module, Intro to Options Pricing. Here I'll talk a little bit about why options are priced the way that they are and how this can help you make as much money as possible. So I want to start this off by saying options and stocks do not move the same way. Sometimes a stock will go up and the option will not go up at the same time. Sometimes a stock will go down, but the option might go up. So it's extremely important that you guys listen to this this chapter or this module because it's going to be one of the most important ones when it comes to options trading. There are four main things that impact an options price, and that's going to be first, the stock price. Of course, if a stock goes up, the options price should go up as well, and this happens in most cases, but in some cases it doesn't happen that way. So the first one is going to be the stock price. The second is going to be time until expiration or the expiration date. If you have more time on a contract, it's going to react differently than if there's only 1 day left on your contract and your expiration. The third thing is going to be your strike price. So if you choose different strike prices, the option is going to react in a different way. And the last is implied volatility. So if there's a whole bunch of movement in the stock price, if projections for the stock are up here or if projections are down here, that's also going to impact the options pricing. This is important because understanding this pricing can help you take advantage of deep discounts when they present themselves or potentially stop you from taking a trade that you might think is good. Think of options pricing as a tug-of-war between time and movement. If a stock doesn't move fast enough, your option could lose value, even if you're right about the direction. So in this module, we'll break it down for you. We'll start off with intrinsic and extrinsic value and what those both are and how they can impact the option price. Every options price has two different parts. First, you have your intrinsic value and then you have your extrinsic value. Once you understand these, you'll know exactly why an option costs what it costs. So let's get into it. Intrinsic value is the value that you intrinsically have, meaning if your option were to expire today, how much money you would make from that option, and this is all based on your strike price and the price of the stock at that moment of expiration. Your extrinsic value is the potential. So this is the potential for the stock to go up, and this is calculated just using the Black-Scholes model and some math. So we're not actually going to get into that. It's pretty complex, but all you need to know is that extrinsic value is just the potential value, and it's just calculated from an equation. I also want to note that extrinsic value, as it gets closer to your expiration, as time passes, extrinsic value is going to decrease because you're only left with intrinsic value once you hit expiration. Your extrinsic value is future potential, but as it gets closer to your expiration date, it's mostly intrinsic value. And this is important when you're picking your strike price and your expiration. So the best way for me to actually show you guys this is to get into an example. Let's use Apple as an example. Say we have Apple trading at $105 per share. So $105. All right. And then we have a strike price of $100. Okay. This right here, that's the price that you can purchase 100 shares at because you have an option contract on it, right? You purchase that contract. So that's where you can purchase 100 shares. All right. Let's just say, for example, your expiration is today. So you have no more extrinsic value. You only have intrinsic value. That's what we're going to be measuring here. Okay. So your strike, So the stock is at 105. Your strike is at 100. All right. All you're going to do to find the intrinsic value is you're going to take 105 and you're going to subtract 100 from it. And you're going to be left with 5. And you're just going to multiply that by 100. So you'll just add a 0 and add a 0. Now, your intrinsic value on that option is $500. Let's just say your strike was 95. Okay? your strike is $95, meaning you have the right to purchase 100 shares at $95. Okay? Because all you're doing is you're doing the difference between the strike and where the stock price is at that moment. Okay? So we'll get another example is if I took 95, right? It would be 10, and then I just add 2 zeros. So my intrinsic value would now be $1,000. Okay? Oops. My intrinsic value would now be $1,000. Now let's go ahead and do this exercise with an actual example so you guys can go ahead and see how options are priced. I came into Apple and I'm going to go to this expiration, okay? 5 days until expiration. We're going to use this 260 strike price, okay? Actually, we'll use 250 strike, okay? So I'm going to write this down and then you'll see it in just a moment. So 250 is going to be the strike. The current stock right now, you can see it is at 259 and 37 cents. So 259.35, okay? So if you come over here, you can see that the option is priced at $1,025. So I'll write that over here is price equals $1,025. That's the price. That's the strike price is 250. It's currently at 259 and those contracts are worth $1,025. All we're going to do is calculate the intrinsic value and the extrinsic value. Note that there's 5 days until expiration, and that's going to represent your extrinsic value. So 5 days till expiration. Now that we have all of the inputs, let's go ahead and calculate the intrinsic and the extrinsic value, kind of how we did before with the previous example. So the way that you're going to find the intrinsic value is you're going to take the stock price and you're going to subtract the strike price. So the stock price of 259.35, and you're going to just subtract the strike price, okay? And you're going to get 935. Okay, you're just going to multiply that by 100 and you get $935. That's going to be your intrinsic value, meaning if your option expired right now at this price, that's how much money you would have. That's what the contract would be worth. Okay, same thing as if, say, the stock stayed there until expiration at that same price, same exact price. That's how much money you would have. If it were to go up to, let's say, $1, say it moves up $1 to 36. Oops, 36. That means you would have 936 at expiration. That's all that means. And that's a whole dollar more when the stock only went up 1 cent. So it's all multiplied by 100. And that's just the factor in this all is that options give you leverage. So let's go ahead and find the extrinsic value now. The way you're going to find your extrinsic value is we're going to look back. Remember that the price was $1,025. We're going to take that $1,025 and all we're going to do is we're going to subtract this right here. You just subtract your intrinsic value from the price of the option. We're going to take the 935, subtract it, and you're going to get $90. That is your extrinsic value or your time value or your future value. It's very, very low right now versus the 935. It's only 10% of it right now. The reason you see that is because there's only 5 days until expiration. Let's use an example where there's a longer expiration. So I'm going to erase all of this, but now we know how to calculate the intrinsic and extrinsic value. You're going to take the strike price and you're going to subtract it from the stock price. And then the way to find the extrinsic value is you're going to take the contract price and you're going to subtract the intrinsic value. That's how you would find it. So let's go and do another example with a longer expiration and a different strike. Now if we come here, we can see that that was the January 16th strike with 5 days until expiration. We're going to come all the way out here to 705 days. All right, we're going to choose the same strike of 250. Okay, so the strike is going to be the same as 250. We're going to use 259.35 because I think that's what I used last time. Yeah, we'll use that one as last time. And that'll be the stock price. Okay, so that doesn't change. All right. The next thing is going to be the price of the option. So this is 250 strike. Now this one's worth $5,290. So $5,290. The days until expiration is going to be 705. So if you look here, how do we find our intrinsic value? You just take 259.35 and you subtract 250 from it. So it's the same as last time. It's just going to be 935. That doesn't change. Your intrinsic value doesn't change unless your strike price changes. Because if this strike price changed, say it went down to 240, okay, now your intrinsic value is going to be 1,035 instead of 935. So it changes. You can go ahead and calculate all of that yourself. You can go through examples. I think it's important for you to know this. But now, how do we calculate our extrinsic value? We're going to take the $5,290 because that's what our option costs, okay? And you're just going to subtract the 935 from it. Our extrinsic value is going to be $4,355. And now you can tell that our extrinsic value is way greater than our intrinsic value. And the only difference is the expiration date. 705 days until expiration versus 5 days until expiration. So that's the only difference because extrinsic value is your time value. So that's important. Time value. Your intrinsic value, that's what you already have made. No matter what happens, if the stock stays there for all 705 days, that's how much you'll make, is 935. But if it goes up, obviously you'll continue to make more. That's your extrinsic value, is this right here. You can also use this information to know what your break-even price is. So if you want to know exactly what price the stock needs to get to for you to break even, you get all of your money back, you don't lose any money at all, what that number is, you can use this right here. I'll go into an example of that right now. Say the strike is 250, right? This is Apple and your strike is 250. Let's just say you paid $5,000 for your option. $5,000 is what you paid for the option. All you're going to do is this would look like this. $5,000 would really look like this. This and that are the same thing because you just take those two zeros, you take that decimal and you move it over 2 zeros. So those are essentially the same thing. And how you would calculate your break-even price is you would go ahead and add the $50 to your strike price. It seems simple. So you would take this number and you would just add it to your strike price. Say your contract is $4,500. It would really look like this. And you would just add that to the strike price. So you'd add that. And now your break-even price, this is the price where you break even, you don't lose money, you don't gain money, is $295. So you would need Apple to get to that $295 level for you to break even on your money. This number right here is the golden number. If it goes past that, everything after that is profit times 100 basically. So every single dollar over 295 on one contract is $100 gain. So if Apple went to $300 by expiration, you'd essentially make $500 because your gain on that would be $5, right? And that'd be worth $500 because you multiply it by 100. Let's say instead of 300, it went to 400, okay? The difference between that is 105. You would go ahead and add the two zeros. Your profit would be $10,500 off of $4,500. So that just goes to show you the power of options and why it's extremely important to pay attention to pricing, both intrinsic and extrinsic value. We'll talk a little bit more about time decay, how you can find that and how you can combat against it, because that's just the extrinsic value coming down closer to your expiration. One of the most important forces in options trading is time decay, or theta. This is what slowly eats at the price of your option every single day. Assuming nothing else, every single option is going to have time decay. So the further out you go, you're going to have a little bit less time decay, and then as you get closer, there's going to be more rapid time decay. This starts to happen around 90 days, where theta really kicks in and you have a lot more time decay. I can go ahead and show you this using our Greeks, but it's really important that you're making sure you're keeping track of how many days you have until expiration and also what the theta is on those contracts. Let's get into the charts here. This is the option chain on Apple, and we'll go 5 days until expiration. You can see over here, I have theta, and you can go ahead and look at the different Greeks. That's what these are: theta, delta, gamma, rho, beta. They're all the Greeks, okay? Theta is just time decay. And you can go ahead and see the time decay right here. And this right here means every single day that passes, your contract is going to decrease in value by $34. This one is going to decrease by $2 every day, but it's only worth $5. So essentially by tomorrow, it will lose half of its value. This one will lose half of its value. This one is $288. It will lose $30 in value. This is 5 days until expiration. If you go further out, say 700 days, you can see theta decay is significantly less. You can see that this contract is worth $4,000, but it only loses $4 per day. So that's absolutely nothing compared to closer to expiration. You can see that theta is a majority of the actual price of the option. So this one's decaying much quicker than the ones with further out expirations, and then we can choose one in the middle, so say 60. This one is decaying at $10 per day, but it's worth 1,000. As you go further out, there's going to be less decay, and then as you get closer until expiration, there's going to be more decay. 90 days is typically when more theta starts to kick in. Just make sure you're being cognizant of what you are trading, when you are trading it, and if you're holding it overnight and for long periods of time. Extremely important to take note of that. Sometimes, if you're an experienced trader, a lot of times people will sell options and they'll take advantage of the theta decay. So they'll sell an option, they'll wait for it to theta decay, and then they'll just buy it back after it has decayed already because they're taking advantage of that $34 loss per day. Some people do that. You need a little bit more money. We'll get into that strategy later. Because it is a strategy that I run and I like to use it for any option that is less than 90 days. I typically like running that because there's more theta decay. I typically don't like holding options that are within that 90-day window if I'm hoping the stock price goes up, because I don't want theta decay, because that really screws people over, and it's definitely important for you to take note of. That's theta decay. In the next video, I'll talk a little bit about the Greeks, so delta, vega, theta, gamma, and rho. I'll talk about what they do and how they're important, and the ones that I use when I'm trading. I'll see you on the next video. Let's talk a little bit about the Greeks and options. So the Greeks tell traders how sensitive an option is to different day-to-day factors, and there's 5 main Greeks that I'm going to talk about here. You got delta, theta, gamma, vega, and rho, and I'm going to show you guys exactly what they are and then explain them at the same time. So if you were to open up your thinkorswim, you come over here and you'll see the option chain, and you can click this one up here, and you can click delta, gamma, theta, vega, and this will pull up all the Greeks. So you've got all these numbers, you've got uh, your Greeks up here, so you have delta here, gamma, theta, and vega, and then you can see the number that corresponds with each of those. So the first one I'm going to talk about is delta. So delta tells you how much the option will increase in value for every dollar move that the stock does. So for instance, the S&P 500 is at $695. We'll just talk about the $700 strike. Okay, so this one right here. If we come over, we can see that the delta is 23. It just changed. The delta on this one is 23. That means if the S&P 500 was to go up to 696 and 16 cents, the option contract that's currently $89 would increase $23. So this is helpful in seeing how much profit you would make if the stock were to move $1 in your favor. For instance, if we come to 695, you can see that the price is $308 for this contract, and every dollar move would increase the contract value by $51. That's essentially what delta is. The next one we're going to talk about is we're going to talk about gamma. Gamma is important because it tells you how much delta will go up for every dollar increase. If you notice here, delta slowly increases. So it goes from 13 to 18 to 23 to 28 to 34 to 30 to 40, 45, 51. Okay? If say SPY was to go up to $696, delta would increase to, it's moving right now, but delta would increase to 55 instead of being 50. If it were to move up $1, delta would now be 55. So you make more as the price goes up. Theta, on the other hand, is your time decay. So I talked a little bit about this earlier, but theta is every single day that passes by, how much that option contract is going to decrease in value. If we were to hold this for a full day and the price was to do nothing at all, say SPY stayed here at this price, this contract would decrease in value by $60, or here 60 cents, but we always multiply it by 100, so it'd be $60. That's why it's very important that you don't hold trades super close to expiration, or you at least need to know what you're doing and being careful, because we can see that every single day that I hold this, it's going to decrease $60 in value. If we come further out in expiration, we can see that my theta decreases to $9. Now, every single day that I'm holding this, my option contract decreases in $9. This contract is worth $6,000 almost. $9 isn't a huge difference, especially because your delta on this is 60. You can see that our gamma is 0. Essentially, it will just stay at 60. You'll make $60 for every dollar move in the stock. The next one we'll talk about is Vega. All Vega does is it measures sensitivity to volatility. A higher Vega just means that price reacts more to changes in implied volatility. And the last one we'll talk about is Rho, and Rho's not extremely important, and it's also not on here, but it measures the impact of interest rate changes on the value of an option. It's not going to be on here. It's not something that you should really even look at. The main ones that I look at are delta, gamma, and theta. Vega is important if you're trading around options or something that's super volatile. I'm not day trading, so I'm only really focused on my theta, my gamma, my delta. The Greeks sound pretty complex, but they're easy to understand over time, and they're extremely important for you to understand before you even start trading options. You should know what your Greeks are on every single contract that you're trading. Those are the Greeks. I hope this video helped you understand a little bit more. If you have any questions, please feel free to DM me or just leave a comment in the Discord, and I'm sure somebody will be able to help you out. Let's talk a little bit more about implied volatility and the IV crush and how it's important to understand what that is as well. What is implied volatility and what is IV crush? So the easiest way to put it is the amount of movement that the market expects in a stock. And this is typically represented by a percentage, and it's a percentage that shows plus or minus where the stock is going to be 68% of the time. So I'll go ahead and show that right here. If we open up a chart on NVIDIA, you can see that in this column I have my implied volatility. You can change that up here, but you can notice, if you notice that I go a year out, the implied volatility on this stock is about 44%. So that means NVIDIA, the shares of NVIDIA will be plus or minus about $77 a year from now, or 68% of the time 1 year from now. So that's what that means. And you can also see this, you can see that it's around 44% on NVIDIA. If I were to go to SPY, I could see that it's significantly less if I go a year out. The same expiration, this is about a 23%, or actually 27% difference, give or take. Now on SPY, the implied volatility is only about 17%. So SPY isn't moving as much as NVIDIA is moving, or it doesn't have the expected amount of move. The market doesn't think it's going to move as much as NVIDIA. This is important when looking at options contracts because higher implied volatility just means that your options contracts are going to be more expensive. And if you have lower implied volatility, the options contracts are going to be lower priced. This is important when looking at events like earnings. During earnings, there's a lot of implied volatility. Right before, there's huge movements up or huge movements down that are predicted by the market. The market thinks, okay, if they report good on earnings, the market's going to sky. If they report bad on earnings, then it's going to tank. So implied volatility increases, meaning the value of options increases as well. But sometimes people will get into options before earnings thinking, oh, it's going to make a big move up. And a lot of the times after earnings, the implied volatility goes down significantly, meaning that the value of those options contracts is going to fall as well. Even if you're right about the direction, say NVIDIA reports earnings, people expect it to move up 5%, but instead it moves up 1%. Your option contracts are going to be IV crushed depending on your expiration date, and you could be left with contracts that are worth significantly less than what you paid for. It's important that you understand implied volatility. I usually like looking for stocks with lower implied volatility, so I look at SPY. I also look at Q. I look at the Qs. These have lower implied volatility. I like looking at, I guess we could say, I like Google. Google's been up really well, but it has higher implied volatility. Um, Most individual stocks are going to have higher implied volatility. If you go with ETFs, they're going to be significantly lower. I like staying anywhere between the 20 to 35-ish range. Anything outside of that is a little bit more risky. If I think something's going to pop, then I'll probably get into something like that. If I want some more movement or if I want to make more, then I'll also do that. If we look at, like, say, Robinhood, for example, Robinhood has some high implied volatility, close to 60%, right? This is going to move. Those option contracts are going to move a lot because of this higher implied volatility. They're also going to be more expensive for the actual price of the stock. So These are all things to keep in mind. I hope this helped you understand a little bit more about implied volatility and helps you mitigate your risk, especially when it comes to buying around earnings and being extremely careful. For beginners, I would recommend staying away from it completely. Don't buy options before earnings thinking, oh, it's going to crush earnings, and then you're left with IV crush. I know it's happened to me before, so it's definitely an interesting feeling when you're like, wait, the stock went up, but my contracts went down. How is this even possible? IV crush is how it's possible, and it's very much a real thing. So definitely something to take into account.